Do you want to know everything about small business taxation? All the taxes your company must pay? Then stick to the end of this video. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous. If you were to ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about small business taxation, all the taxes your company must pay. You have to keep in mind, though, folks, there are multiple types of taxes. I'm talking federal, state, and local that a business must pay, and some of these levies are easier to understand than others. So depending on the business activity, nature, sector, and risk level, I'm talking about environmental damage, for example, an entrepreneur must pay extra taxes. So if you're just starting your business, you got to know what taxes you'll be expected to pay. Another important thing, and this is for freelancers out there, if you are a freelancer, small business owner, or an independent contractor, you are not an employee. Let me repeat that. You are not an employee. So the money that you take out of the business is not a paycheck. So you pay taxes on your share of the profits of the business. Let's just kind of go a little deeper here. What about income taxes for small businesses? So all businesses, as I said before, must pay taxes on their income. In other words, the business must pay tax on the profit of the company. How the tax is paid depends, however, on the legal structure of the business. So most small businesses, they are what the IRS calls pass-through entities. In other words, the business taxes are passed through to the owners on their personal tax returns. So once you get that picture, let's proceed and explain that income taxes and self-employment taxes, in other words, Social Security, Medicare tax, those are based on the net income of your business for the tax year. It's the same thing as profit. So profit, when I'm talking about profit from an accounting standpoint, is income minus expenses. So if you share a business with others, the net income is divided between all the owners based on their agreements. Now, what about sole proprietors? Sole proprietors and single member LLC owners, they pay income tax based on the net income of their business. So to determine the net income, you got to complete something called Schedule C as part of your personal tax return. We have covered the subject of Schedule C in another show, so you might want to double check that show and understand the ins and outs of a Schedule C. So the net income from Schedule C is added to your other sources of income to determine your total tax. Partners in partnerships and multiple member LLC owners, they also got to file a partnership business tax return, and that is the 1065-P, but that tax return is for information only. So they are sending it to the IRS, and the reason why they do that, the IRS want to reconcile the taxes they're showing for the partnership versus the aggregate of the taxes that the partners are filing with the IRS. In other words, the IRS just want to make sure that no partner is actually cheating on their tax returns. So the individual partners or LLC members, they pay income taxes on their share of the income of the business. So at the end of the year, actually at the beginning of the year, around February, the first week of February or the last week of January, they will receive a Schedule K1 that shows their income from the business, and they need to add this schedule to their personal tax returns. Owners of LLCs, they are taxed as either sole proprietors, in other words, if you have one owner, or partnerships if they have multiple owners. So some LLCs can even elect to be taxed as a corporation. So I will talk about that later on. But so you have S corporations, you have to understand, are similar to partnerships. So the owners of S corporations, S corps, they will divide up the income of the business, and each owner receives a Schedule K1 to include in his or her income tax return. So remember that we've had recent tax legislation. So effective for 2018 and forward, you as a business owner may be eligible for a new 20% tax deduction. This is called the QBI deduction, the Qualified Business Income Deduction. And this is in addition to your normal business expense deductions. So this deductions apply to sole proprietors, partners, LLC owners, and S corporation owners. So and you can actually, the deduction may also be claimed on certain dividends for corporate shareholders. Continuing our conversation about small business taxation, let's talk about income taxes for corporations. So if you have a corporation, a C corporation, that's the same thing as corporation. Corporations, they basically have something called the 1120. So they pay income taxes as separate entities for their owners. So the corporation files a tax return on IRS form, and this is called 1120 for the year. The net income from the corporation is not taxed unless it is distributed by the company to the shareholders, usually in the form of dividends. The profits kept in the corporation are classified as retained earnings. So the thing here you have to understand is that people talk about double taxation for a C corporation. That's because if you are a shareholder, you pay taxes on you as the owner of the company. You pay taxes on the dividends you receive from the company, but also the company itself pays taxes when it distributes those dividends. So this is double taxation, and this topic has been pivotal in fiscal discussions in the last 20 years. And I don't think this is going to be fixed right now. Congress and several stakeholders, they are still discussing this topic. What about self-employment tax on each owner's share of business income? So self-employment taxes, they are paid by the sole proprietors, partners in a partnership, and LLC owners for Social Security and Medicare based on the net income of the business. So owners of corporations, they're called shareholders, so they're not self-employed. S corporation owners are not considered self-employed, and they don't pay self-employment taxes. So self-employment tax is paid on the net earnings of the business. Net earnings mean that you do your income minus expenses, and if you have to deduct some taxes or other extraordinary items, you do that as well. So no net earnings for a year means no self-employment tax. So it also means you don't get Social Security, Medicare credits for that year. You must calculate self-employment taxes using Schedule SE, self-employment, and you have to add the total of this tax due to the tax due. You have to add it to your personal tax returns. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. I'm still here having a conversation around small business taxation. I'm just explaining to you all the taxes your company must pay. And if you love the clarity and quality of the content so far, please consider subscribing to our channel and turn on the notification bell so we can inform you in real time about our new shows. And we release this kind of shows every single day, rain or shine. Let's talk about estimated taxes for business owners. There's something called estimated taxes. Because you're the owner of a business, no one withholds income tax and self-employment tax from the money you take out of the business. In other words, you don't get a paycheck because you're not an employee. If you were a regular employee, your employer would be taking taxes every 2 weeks or every week or every month. Whenever you're paid, they will take some taxes out of your paycheck. It will take the FICA taxes, the Social Security, and other taxes. So you're not an employee, so you don't get a paycheck. So you got to do certain things yourself. The IRS requires that these taxes, I'm talking about income tax and self-employment tax, that these taxes be paid throughout the year. So you must pay estimated taxes quarterly. The first payment of the year is due April 15th, then another one on July 15th, and then September 15th and January 15th of the following year. Let me repeat those dates. They are critical, folks. So April 15th, July 15th, September 15th, and January 15th of the following year. So you got to send a check to the IRS every 3 months. The estimated tax form for business owners combines business and personal income and taxes, including self-employment taxes. What about sales tax on products and services sold in certain states? Businesses, you got to understand, don't directly pay sales tax on products and services they sell. But if your business operates in a state that has state income tax, you must set up a system to collect sales tax form from your customers, and you have to report and pay that tax to your state. Merchants in most states are required to collect sales tax and pay it to the State Department of Revenue. Specific products and services are sales tax eligible depending on the state law. So you want to double check with your State Department of Revenue to know exactly the right information, to have the right deductions, the right restrictions, and the right benefits when it comes to sales tax. Money must be collected from customers. So when you sell, you have to collect the money from the customers. You have to report it and you have to pay it on a regular basis. Don't forget sales taxes for items you sell on the internet. That's kind of important. A lot of people think, oh, well, I'm just selling the internet and I don't need to. No, you have to collect sales tax from your customers even when you sell online. A recent Supreme Court decision allows the state more freedom to collect sales taxes from online sellers located in their state. That means you may need to change sales tax to your online, you need to charge sales tax to your online customers, and you have to pay the tax on a regular basis. What about property tax on business property? Do you have to pay those? Yes, you have to, because property tax is a local tax. So if your business owns real property, real estate like a building, your business must pay property tax to the local taxing authority. And this is usually the city or county where the property is located. So the tax, though, is based on assessed value. So that's the same as for personal property like a house. There are some special consideration. So when it comes to federal taxes, you have to you want to inquire with a lawyer on that. But there are some special considerations for paying federal taxes when you sell a piece of business property. So you may have to pay capital gains tax on the difference between your initial cost and the selling price. So again, you want to talk to a tax professional before you sell business property. So this can be a CPA, a certified public accountant, or an EA, an enrolled agent, or even a fiscal attorney. What about excise taxes on use and consumption? Excise taxes are paid by a business for certain types of use or consumption, like fuels and other activities like transportation and communication. Excise taxes are paid to the IRS either quarterly or annually, depending upon usage, and you have to use the Form 720. If you use Form 720, you can pay your excise taxes on use and consumption to the IRS every quarter. You have employment or payroll taxes paid on employee earnings. And again, folks, I'm just giving you the list. I'm giving you the catalog of all taxes that your company must pay. So employment taxes are taxes paid by employees and employers, including federal income tax withholding from employee pay. You have FICA taxes for Social Security and Medicare, and this is paid by both the employee and the employer. And then you have the FUTA taxes. FUTA stands for Federal Unemployment Taxes. So those are paid by employers. So just get it straight. So you have FUTA, so Federal Unemployment Tax. This is the employer's responsibility. FICA tax is the responsibility of both the employee and the employer. And then you have federal income tax. So you also have employment taxes, depending on the states where you live in. So you want to double check with that state. One thing let me just quickly get back to the FICA taxes, because this is something that a lot of business owners, small business owners don't understand. There are several steps when it comes to paying the income tax and the FICA tax. You must calculate federal income taxes and on both first of all, you have to calculate federal income taxes on the employee's salary, gross income. So both the employee and employer portion of the FICA taxes are based on the employee's gross pay. Then you must withhold these taxes from employee paychecks every 2 weeks, every month, it really depends upon your payroll system. Then you must pay this taxes to the IRS, including your portion of FICA taxes as an employer, by depositing the total amount monthly or semi-weekly, depending on the size of your payroll. You must also report amounts owed and paid quarterly on IRS Form 941 and pay any additional employment taxes due. Unemployment taxes are separate, and those are paid entirely by employers, not employees. I think I already said that earlier. So the amount you must pay as an employer is calculated based on a portion of the income of your employees. So one thing you want to do is you also have to use Form 940 here, not 941. So you must report the amounts you owe and have paid each year on that form, IRS Form 940. What about the gross receipts tax and state income tax on businesses? Most states have a state income tax for businesses. So I would say the vast majority, but some states like Nevada and Texas, they impose a gross receipts tax on businesses instead of or in addition to a state income tax. So in this states, aka Nevada, Texas, gross receipts, gross revenues of the business are taxed. So some states allow deductions for this tax, and some types of businesses in some states don't have to pay this tax at all. Sole proprietorships are usually exempt from paying gross receipts taxes, but not from state income tax. So you have to really understand. You have to understand that this video we've been talking about a lot of taxes, and you have to clarify what kind of status you're in. Are you a sole proprietor? Are you the owner of a business, of a C corp, of an S corp, are you a partner in a partnership? So you have to first determine that. You want to check with your state to see if you must pay the gross receipt tax. So most small businesses pay state income taxes on business income through their personal tax return, similar to federal income taxes. So those are really stuff. This is stuff that you have to really clarify with your maybe a tax attorney or a tax accountant before. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I'm still talking here about small business taxation, and I'm giving you a list of all the taxes your company must pay. What about dividend tax on corporate shareholders? If you are an owner of a corporation, you are a shareholder. So that means you gotta pay income taxes on income you received from dividends. Earlier, I was talking to you about the double taxation conundrum. This is it. You have to pay taxes on dividends, and the corporation has to pay taxes on its income. So each corporation decides when to pay dividends and how big the dividend will be. Dividends are not considered earned income, and you must pay a special dividend tax rate on dividends you receive through your personal tax return. So when you file your 1040, you normally would have received a form 1099-DIV, and then you'll receive that from the entity that received the dividends on your behalf and transfer it to you. Sometimes it's through your broker. So your broker at the end of the year will send you a form 1099-DIV, and you will see the amount of the dividend paid that year. So you must include that information on the appropriate form, depending on the type of dividend and how long the dividend was held. All right, folks, this is it. I just ran through 10 taxes your company must pay. And here's a recap. So income taxes for small businesses, income taxes for corporations. I also talk about self-employment tax on each owner's share of business income. I had a conversation also around the estimated taxes for business owners, sales tax on products and services sold in certain states, property tax on business property, excise taxes on use and consumption, employment or payroll taxes paid on employee earnings, gross receipts tax and state income tax on business, then dividend tax on corporate shareholders. I will see you another time. But until then, remember, stay marvelous.